So essentially, India was at the right time in the right place because you had the entire Aadhaar-based KYC engine operating. You had payment gateways operating. People knew how to use UPIs. SEBI has been constantly talking about the fact that there is something tremendously wrong with the way the derivatives market has completely overtaken the overall market psyche.
You mentioned 4 clear sectors, and I just realized that 2 of them didn't even exist some 10 20 years ago. The very first one that you spoke about was within the financial space, exchanges, brokerages. Correct. Second you mentioned was EMS. Third and fourth are of course something that is known to pretty much everyone, which is consumption and infra.
We are looking at this country as a long-term phenomenon. Prime Minister Modi keeps talking about 2047. All the youngsters should think of at least 2047.
Hey there, and welcome to Paisa Vaisa. I'm Anupam Gupta. Want to get smart with your money? We bring in top experts to show you where to invest, what financial trends to follow, and how to build lasting wealth. Ready to get smarter with your money? Hit that subscribe button for Paisa Vaisa and check out our episodes. Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, and on today's show, I'm talking about how the equity culture is doing in India. My guest Sandip Raichura, CEO, Retail Broking and Distribution and Director, PL Capital. Folks, PL is Prabhudas Siladar. Sandip, welcome to Paisa Vaisa.
Thank you so much. My pleasure.
Thanks so much for doing this for our audience. It's been 2 years since PL has been on our show. I think last time we had Amisha Bora and now we have you. Just a small recap for our audience. What exactly is PL? I'm still a little bit old school, so I'm still stuck on the Prabhudas Siladar. I like the sound of it. Its history, what it's been doing, what it's doing. Let's start with that.
No, PL is a brand that comes with great lineage. I mean, we've been around for almost 81 years now. And we've seen the ups and downs. So, that sort of has seeped into our culture where we believe that there's tremendous value to be added to investors, both retail as well as institutional. PL today has evolved into a full 360-degree financial services outfit. And by that, what I mean is that on the one side, we've got mutual funds and institutions as our customers. On the other side, we've got the average mass affluent family. People looking at building their finances for their future, for their kids' education, and so on and so forth. So in doing that, we today, I think, are present across all asset categories. We are ourselves reputed for the research that we do. So we add a lot of value through the equity research. We also now have a full-fledged investment banking division that engages with corporates in tier 1, tier 2, tier 3 cities, across the latest technologies, clean tech on the one side, and on supporting the Make in India initiatives like, manufacturing, etc. on the other. So I think we have now come around a full circle where PL intends to be for its investors or for its future customers who are raising money, full services outfit that can sort of fit into whatever it is that they wish to dream of.
So folks, as you know, if you've been following the show, we usually have a lot of CIOs and analysts and fund managers and people talking about kya lagta hai about the market. I'll tell you why I like having people from distribution from large brokerages. It's because these are the guys who know the mood on the ground. So I want all of y'all to first understand. Sandip, explain to us, what does your day job involve?
All right. So essentially, we are a fleet of close to about 1,100 offices across the country, right? And which therefore implies we've got roughly about 4,500 people on the ground meeting investors on a day-to-day basis. So typically a day would involve generating advisory ideas, updating the teams on what it is that they should go and present to their end customers. Of course, launching products or services that our customers want using a lot of tech. We've increasingly become a very tech-oriented company. And of course, ensure that anything that the customer wanted to engage with us on is responded to by the right people. So my job is to be the sutradhar, the coordinator, to ensure that we actually deliver what it is that we promised. As a brand.
Yeah, so Sutradhar, that's a nice word, storyteller. What has been the story on the ground, right? Because our popular understanding is that post-lockdown, post-COVID, everybody jumped into equities, DMAT opened up,
Correct.
SIP opened up.
Correct.
Just give us a recap and then let's use that point to probably extrapolate as to what you think is going to happen in the future.
No, I think so. Even prior to COVID, right from the time the demonetization came in, right, there's been a lot of popularity of financial savings as the right way to go, right? So financialization actually got a big kicker out of that entire event. COVID was just one more trigger along the way where people realized, people had a lot of time at that time, right? And what do? So you do Zooms with your bosses or you pick up an app and do something. So not only equities, but actually cryptos also took off. Yeah. So essentially, India was at the right time in the right place because you had the entire Aadhaar-based KYC engine operating. You had payment gateways operating. People knew how to use UPIs. All of that technology was bang on because when we needed it the most, people realized that their app could actually become a way to generate wealth. So yes, so you're right. So a lot of youngsters from tier 1, tier 2, tier 3, I mean all across India started participating. And that's picked up speed along the way. In terms of numbers, of course, the initial sort of acceleration that we saw during the first couple of years has slowed down. Because as people became busier, as portfolios started generating more wealth, people obviously do not want to turn over their portfolio so many times. But I think it's a structural phenomenon in a country where we have close to about 9 crore or so PAN numbers. Roughly about, I think, 4.5 or 5 crore people who earn upwards of 5 lakh rupees filing their taxes. This entire generation is going to incrementally be a larger and larger base over the next 10-15 years. So while the numbers may not be as fascinatingly, incrementally positive as we saw probably during that time, the amount of wealth per PAN number that's invested into financial markets is likely to continue to grow at 20 to 30% per annum, is our broad estimate.
You know, when you give me those numbers, the one number that always sticks out to me, especially during the IPL, is the user base of Dream 11, 20 crores.
Yes.
Right?
So imagine,
I'm just looking at the potential that's there. But
Correct.
then the other thing that I speak with a lot of people about how Dream 11 has picked up is now, for the lack of a better word, gambling.
Correct.
Okay, could be, you call it gambling, speculation, addiction, whatever.
Absolutely.
I don't want to talk about the dark side. That's
Correct.
a different story
Correct.
altogether. But we
Correct.
do know for a fact that, and SEBI has kind of confirmed this with a lot of
Absolutely.
statistics,
Absolutely.
that a lot of retail trading activity also picked up along with these numbers.
True.
Now, on one side, you've got the good side, which is the SIP side, disciplined side,
Correct.
financial side.
Correct.
And on this side, you had this kind of explosion
True.
in trading activity.
True.
When you speak to your staff or your staff speaks to you, or what you can see, because you've also been in this
Yes.
industry for a long time, you would know that this is not something that's normal.
Correct.
Okay?
Correct.
And then SEBI stepped in.
Absolutely.
Can you just walk our audience through how this entire trading boom, where it started, why it started, was it because of boredom, was it because of something new? What's been happening there? Because you would see this in the activity that you have at PL also.
Yeah.
Please tell us.
No, I think there's no general principle as such, but you're right, it's a combination of things. So, I mean, people had a little bit of money. So, options instruments, for example, and you had a lot of YouTube influencers, you had all kinds of recommendations coming from all kinds of places. So within all of that, when you get enough time or adequate time to sort of play around possibly with your money, it's often possible that for 10K or 20K, if somebody is promised a return of 10K and 20K almost overnight, people would tend to get fascinated. However, it's not this generation, post-COVID generation only. I mean, that's been true right from 2017 onwards. So
Wow.
SEBI has been constantly talking about the fact that there is something tremendously wrong with the way the derivatives market has completely overtaken the overall market psyche. Right?
Yeah.
And remember that at the back end somewhere, we are still a wealth generating nation, right? It's not as if people are in the capital preservation mode, right? People want to make money very quickly. So it's an older phenomenon. Possibly we are noticing it more often during the COVID times. SEBI has been attempting to, of course, control it, and it's taken a vast variety of initiatives, right? So there were two things wrong with us. One, broadly, the entire structure of how the securities market operates was relatively opaque. SEBI has possibly made it the most opaque structure in the world today. And in doing that, they've possibly advanced technology to another extreme, right? Second, their specific focus on ensuring that derivatives is not a high percentage of the overall volume. They've taken a lot of steps, like increasing, the size of the contract, increasing the margins over a period of time, etc. However, I think there is possibly one more step that they at some stage will take, which is linking derivatives to either PAN numbers or income tax returns, and possibly that's when we will see some moderation. Otherwise, in a country where people have the risk appetite, and good for us all that India is a country where people are willing to take risk in a policy climate that's very stable. People want to take incremental risk. Possibly derivatives is not the way to go. And SEBI will possibly try to clip some of those excesses.
Are there any trends or anything that you've noticed about this entire class of investors, who've come in these last 5 years? Where do you think they're going, where they are today?
I think quite a few things. So one, while we label the entire generation as a young generation, etc., some of those pockets of investors have actually made tons of money. They may have started with possibly a speculative kind of mindset. 5 years down the line, some of them visit us in our offices, and I'm shocked and surprised at their understanding of the depth of the capital markets. and they ask very, very relevant questions. So there's this huge new breed of youngsters, 25, 27, 28 years old, who know exactly what they're talking about. And not only do they know, they're going around advising investors, collecting certificates, going abroad, learning how international organizations operate, and attempting to set up such outfits in India. And we meet many of them. And I'm shocked at the speed at which they've managed to, so 5 years, long, short, I don't know, but amazing experiences that some of them have gathered. Some, anecdotally speaking, some investors have learned over a period of time that trading doesn't make sense, held on to their portfolios, made a lot of money, now incrementally becoming family offices or tiered family offices, etc. So that's the responsible set. We also see quite a few investors who burned their money in derivatives or who actually not made money except if they were in SIPs. Such investors over the last 6 to 12 months I've been seeing from, again, anecdotally, where their ability to interpret, not panic during market bad adverse situations, have started realizing the value of stock picks.
Okay.
And some of them tend to be people who were earlier with discount brokers approaching us and saying, the reason I've come to you is because we want better advice for my portfolio.
Nice.
That awareness has been increasing. Of course, I'm talking from the point of view of people that I would have met. I cannot speak for them all. But the fact is, the average Indian investor, I believe, and the young one especially, whether it's tier 2 or tier 3 doesn't matter, is far more educated or literate about financial markets than an average person of that age was probably a decade ago.
Yeah.
No doubt about that.
Very interesting.
Very responsible investors.
Yeah, and is this trend specific to metros, or you see this across in tier 1, tier 2 cities also?
No, so like I told you, so some of these investors, actually we had, for example, 2 very young kids come to us yesterday. And they spent an entire day in our office learning about markets, learning about what mistakes they might do, which they don't want to do, because they are catering to their family business, which is spread across 4 or 5 locations. Typical tier 3 city, not even tier 2. So the fact that they took this initiative, one of them has gone abroad for 3 months, learned how a particular player operates there through some contacts, came back to India, had the right set of questions for us, had no patience for random conversation, was very focused around what he wanted to know, took back a lot of information and is going to now engage with that information with his family's money. So such kind of behavior is spread across cities. And there's no longer a disconnect between tier 1 and tier 3. There's a very sharp exchange of information, through social media, through family connects, etc. So people have very similar belief systems. India is becoming very, very, singular in that sense.
Okay. Moving to the brokerage business model as such, there was a time, I think 20, 30 years ago, and you would know this more than me.
Yes.
It was largely based on expanding as much as you can, which is number of clients, and mining as much as you can, which is within one client, going deeper, either selling them more stocks or selling them more products.
Correct.
With technology, everything is moved to an app.
Correct.
What's happening at PL? How are you guys looking at your business now?
No, I think, so like you said, so the underlying business principle does not change, right? It's always about volume into the quantity. Correct. So where you had FOS on what used to be called the feet on street, right? Big armies of people going out, knocking on people's doors, etc. That's probably become the app, right? A 7-minute account opening. In terms of the ability to cross-sell, it was possibly not so well synchronized earlier, where each individual RM would have his own fancy. The app sort of now is able to connect with the customer, nudge them to do the right things across products, right? So the end objective remains the same. It's only the approach that has changed, as far as I can think of it. What PL is doing essentially is, so we believe that so while there's a discounted market, the potential for the advisory market is substantial. We believe that if we can sort of leverage on our advisory skill set and make it available to Indians across the nation, irrespective of their geography, using very smart technology, which has a bit of innovation around it, because delivery also matters, right? You're connecting with the person remotely. Indians are very sentimental. So if you have to replicate that online, your technology has to be instant, immediate, and very, very intuitive. So we have, in the last couple of years, we've built a large digital team. We have onboarded CTOs. We've onboarded some of the best vendors to be able to bring out what we consider our dream app in about, I think, 6 to 9 months from now.
It will happen.
It'll happen.
Okay. Very interesting. The one thing that I always find, at least on social media, is on days of heavy activity, election results, some global turmoil, all apps freeze, websites freeze, orders aren't going through your, and in the markets, that second to second, one price tick can be,
Correct.
What's been your experience so far as those freezing and those issues are concerned? Today, people have a place to vent out their frustration. How's that going along?
No, I think that's, all of these phenomena we've started learning over the last 4-5 years, right? Where sudden crashes or freezes, a couple of instances at the market infrastructure level happened. A couple of instances where sudden spikes, unexpected spikes happen. But I think technology has progressed enough now where concurrent usage or instant spikes can be taken over by the cloud.
Sure.
The regulator is also very sensitive about this because of the kind of issues that it creates, and it's been issuing a lot of guidelines to all market participants, right? What kind of infra to have in place, how to deal with such issues, etc. So I think progressively we are possibly in a situation where in a couple of years from now, you would not hear about these things very often.
Okay.
The exchanges are hypersensitive about this, and so are we as market intermediaries.
How is the brokerage industry doing? I remember, there was this time when it was basically on the whims and fancies of the market.
Correct.
Market acha chal raha hai, brokerage acha chal raha hai.
Correct.
That's because
Correct.
the model is only that way.
Correct.
Sentiment is good. You have the same set of people. They trade more, they trade less. I don't know, last 4-5 years, if I just look at the prices of brokerage stocks and their profits, they've been moving up a lot.
Oh, yes.
Whether that's driven by a combination of more users coming to the platform, more users also trading and investing more. So, from your vantage point at PL, how's the industry been doing? Any trends? Commission rates are, of course, competitive, but with more people coming in, that kind of takes care of that, So,
Correct.
What's your view on profits, revenues, future, everything?
No, I think, first of all, I'm very pleased because last 5-6 years, we constantly benchmark ourselves to competition. So our yields have actually not moved a bit. Okay. Right from 2015 onwards, we track it and trace it almost on a quarterly basis just to see whether the pressure is sort of coming on our books. Luckily, we've been managing to avoid that, which sort of proves that our advisory sort of is able to get that premium in the market so that we don't sort of succumb to that pressure.
I want you to spend just 2 minutes more on this for our audience because I'm assuming that our audience is like all Indians, very price sensitive.
Right.
The minute you get onto an app, you make your first trade, the contract note comes in, and you see, "Arey, ye kya? Brokerage itna? I don't want to trade to this. Let me go. Let me switch to someone who's zero brokerage." And we will talk about that, folks. But explain to us how you've held on to the yields, and why is advisory important? Why are you able to hold on to those margins, and what's worked?
Now, see, India is still a developing nation, which means two things are required, right? From the investor's perspective, there's a lot of knowledge sharing that needs to happen for them to sort of make wealth. On the other side, you've got a large range of enterprises listing on the markets, doing things which possibly the average investor may not understand. And therefore, we need to have a radar that's constantly watching for signs of opportunity and signs of risk, where customer monies could be at risk. Now, all of this is a very resource-intense affair, right? For example, all my research, we've got an institutional research team with about 35 people on the ground who are almost, everybody is at least 2 decades in the industry that they lead, right?
Wow. Okay.
With these kinds of resources, with the kind of effort that they have to put on being on the ground, talking not only to the corporate, but to the corporate's dealers, etc., to get signals of whether this is the right place for investors' money to be in.
Yeah.
Now, I need to be able to charge a premium to sort of pay for all this.
Obviously.
Right? That's the typical difference between a chemist and a doctor. If you knew what's wrong with you, you could go to a chemist. If you don't know or you want a second opinion, qualified opinion, you go to a doctor. Yeah. We consider ourselves, in a colloquial sense, doctors for financial markets. In the sense that if you need advice on how to build wealth, please come to me.
Got it.
All right? Because that's the skill set that I carry. Now, that's the value that advisory can have. Now, the world is also becoming more complex. There are opportunities across the globe, not only equities, also debt. There are newer risks in terms of currency fluctuations. Taxation has become extremely differentiated, right? All of this requires us to constantly engage physically, which means I am not just a remote digital presence. My relationship manager will come to your house and explain all this to you. Right? So all of this package needs to be profitable. And the only way I will be profitable is when the customer respects the advisory and relationship that I bring on board, and vice versa. So therefore, we are in a slightly different world where we believe that please engage me for value add, but let me charge for that value add. Right? That's what we would call the entire
and
advisory
people are willing
package.
To pay for it.
And people are willing to pay for it. year after year,
Yeah.
instance after
Yeah.
instance.
Let's go back to the conversation you were having about how yields have sustained or improved. Let's follow that line of thought.
So consciously, so our entire network, all the discount broking phenomena sort of started in the mid 2015s, right? We've been sort of educating our investors, we've been educating our intermediaries to engage with the right set of customers.
Okay.
So if you're a very, very price sensitive customer, if you tend to know what you want, unfortunately, PL may not be the place for you. But if you want hand-holding, if you want constant 24/7, 365 days a year kind of service, if you need us to tell you what could go wrong with your portfolio, what could go wrong with the potential future returns, etc., then I'm the right place to be.
Interesting.
And because of that, what has happened is that over a period of time, people have started learning that PL is the place for X kind of value-added service, and XYZ could be for Y kind of service. So it's not as if all customers of a discount broker may not have accounts with me. So there are lots of our customers who have accounts with discount brokers, possibly doing derivatives trades there, but a large book with me where they need my account. So it's a hybrid kind of situation, but we prefer dealing with premium customers.
Folks, we are going to talk about the future, more about Sandip's view about the market, sectors, whole lot of other stuff on the other side of this break. Don't go anywhere. We will be right back.
Did you know Indians report nearly 800 cases of online financial fraud every day, which has resulted in losses exceeding 1,000 crores in the last 5 years? To keep you safe from such fraud, I am starting my newest podcast series, Conversation with Vigilante, an initiative by HDFC Bank. In every episode, I will feature special guests who can share expert insights on the different types of fraud, their modus operandi, and how you can protect your money. Stay safe, stay vigilant, and don't forget to tune into Conversation with Vigilante. Catch the episodes on all audio streaming platforms and V for Vigilante YouTube channel.
Welcome back. Sandip, how are your feet on the street? How are your distributors of financial products? How are your, the people who are sitting in the terminal, in front of the terminal at your offices when clients come in? This is basically your staff.
Correct.
What's the feel that you get from all of them? How has that feeling been going for the last few years?
No, I think India is a very optimistic place to be in for the last decade or so. The only major difference that I'm seeing is that earlier people would panic at every correction, right? And markets do correct by 15-20% on an average. For the last 5 years, when people panic, their reaction is not selling. Their reaction is much more calmer. And when they come in, they typically, I think, and I'm saying this from an average anecdotal kind of feel for the situation, they would ask for newer ideas, averaging ideas, which was not the case earlier. You would see complete washouts in certain sectors and stocks, which doesn't happen anymore. So I have not seen a washout situation that almost now, I think right from 2018 onwards. 2018 January was possibly the last time that we saw a unilateral sale across the board. After that, people have become much more, they have a larger appetite for taking risks. So the question that we get asked is, nikalne ka nahi, par lene ka kya? That's I think across the board. And therefore, our advisors are constantly trained to first pacify investors during market downturns. Tell them about what asset allocation is, tell them about what risk return ratios are, how diversified their portfolio should be. And we've built some technologies around that to assuage concerns and then get them to actually invest. And we've seen this repeatedly. Right? If the customer sort of is taken care of during a very bad turn in the market, the kind of wealth that he can generate over the next 4 to 5 years is fantastic. And which is where we earn investors, right? So if you're standing with them during bad times, they make money during good times. And that's essentially our job.
And that's important, right? Because how will your client judge you or value the relationship that
Correct.
is that
It
he
takes
has
a
with
long
you?
time.
It takes a long time.
Lots of experiences.
Right. So what are some of the ideas or investment strategies that you're currently suggesting to your client? Any sectors? Basically, the very standard question of kya lagta hai or whatever you want to call it, long-term view or whatever.
Yeah. So even as recently as about 6 months ago, I think everybody had written off the market saying, markets are going to go here. We have been temporarily extremely bullish right from 2021. In fact, PL calls it India's golden decade.
Okay.
We've done a lot of thematic conferences around that, seminars, etc. We believe that markets are on a linear kind of run for the next 10 years. And you might have those 15-20% odd whipsaws. And we could get into multiple reasons. The kind of things that are just taking off in terms of technology, the kind of things that the government is backing it very robustly on. Second. 3, things that do not have very high linkages across the board internationally. And 4, something that depends on India's domestic consumption themes. A combination of these 4 or 5 ideas sort of generates a vast list in India today, which is not the case possibly. So if you talk in terms of sectors, so for example, the entire financial services sector, right? You've got wealth managers, you've got depositories, you've got insurance companies, you've got asset managers, and you've got, of course, brokerage firms, right? All of them cumulating profitability on an average of 3-year CAGR typically would be in the range of 30 to 50%.
Wow.
Right? Exchanges are operating at a PAT margin of about 50 to 60%. PAT margin, right? Where on this planet would you find a democratic government, stable policy, powerful central structure, and organizations with this kind of profitability sitting on a 90% unexploited market, right? So financial services, of course, is at the core on the liability side. On the commercial banks, right? Private sector banks. So the entire financial services realm is one core portfolio holding that we are advising investors on. The second bit is around technology. So we have often recommended ideas, especially in the EMS space, which is, so as China +1 takes off and Europe +1 takes off, the entire EMS space, consumer electronics, etc., is one massive space to look out for. Right? Consumption, of course, remains a permanent theme. Right? India is a consumer nation. Therefore, FMCG stocks need to always be in your portfolio. And of course, other than that, we've got ideas in. So, if India is to become a manufacturing giant, it has to invest. And this investment is best captured by what you would call the engineering and T&D plays. Right? You need energy and you need manufacturing. So I think our ideas rotate around these 4 or 5 sectors, and we brought out a lot of those through our topics, which we release every month on our website.
Is that accessible to the general
public? It's accessible to everybody. No, so you just go to plindia.com, my research section, and the latest ideas with an extremely diverse set of topics that we call are presented with the rationale for why you should be investing.
Folks, plindia.com, you can check out all the research that you want out there. Any risks, any challenges? I mean, one of the things that keep on coming a lot these days is about IT sector salaries haven't moved in the last 10 years. Employment issues, employment challenges, disruptions, AI, for example. Any challenges that you feel could have some kind of a negative impact on the story?
On the India story, not so much. The India story might be impacted, of course, by geopolitics, right? Nothing can stop India from moving into what should be rightfully an India story 10 years from now. China started its manufacturing prowess sometime in the 70s, and it took them a long time before it emerged into a global power, right? India is possibly concertedly moving in that direction for the first time. So I think the spread of wealth, capex, infrastructure, logistics is going to be a long-term 20-30 year phenomenon. And capital markets would follow that trend. Geopolitics is the major concern. Sectorally, of course, there will be a lot of issues. I mean, for example, the rare earth thing happening with China right now, tomorrow it could be something else. Those things would come and go. But in a diversified portfolio, which sort of looks at the longer-term trends, I think individual sectors could impact you by 2 or 3% here or there. But if, touch wood, as long as geopolitics is under control, I think India is set to make an average investor anywhere from 15 to 25% per annum, depending on their risk appetite.
My God, 15,
and that kind of portfolio allocation needs to be constantly monitored. Because, so I mean, just to give you an example, the world's second largest exchange is still not listed.
Hopefully it will.
And when it does, and when it lists and when it comes on the index, now imagine the behavior of the index over the next 5 years. You've got a substantial amount of profit that is coming virtually what I would call annuity income through the exchange, right? So it will not only reduce the volatility of the index, it suddenly puts a lot of cash into the index, which means suddenly you see valuation ratios becoming much more attractive, right, to a foreigner. So all of this kind of behavior is going to bring a lot of capital in, bring a lot of opportunities in.
Very interesting. Folks, I mean, you mentioned 4 clear sectors, and I just realized that 2 of them didn't even exist some 10, 20 years ago. The very first one that you spoke about was within the financial space, exchanges, brokerages, basically what we call NLEs or whatever. There is insurance also, and that's anything outside of core banking would be that. Didn't exist 20 years ago. Now it's this massive chunk. It's a great place to pick and choose from. Second you mentioned was EMS and consumer. EMS didn't exist. I don't know about the valuations and all, but let's not go there. Third and fourth are of course something that is known to pretty much everyone, which is consumption and infra. It could be power, could be cap goods, could be whatever you want. So you think these are the 4 sectors which should be in the limelight now for the foreseeable future?
Absolutely. So these would form what I would consider a heavy bent on. So India is a 3D economy, right? So in a sense, I'm talking about the 3 Ds. The third D is defense. right? So geopolitics is the ring fencing that you need on your portfolio. Defense did not exist as a sector, right?
Okay.
So by defense, I don't mean that we are talking wars only. We are talking a lot of R&D. We are talking a lot of missiles. We are talking about a lot of robotics. We are talking a lot of AI implementation in radar and sonar systems.
Going to come in the private sector also.
That's still nowhere on the radar, right? You've got a limited set. So the 3 Ds, which is maybe demographics, delivery. Delivery is essentially logistics and manufacturing, and defense.
Wow.
If you're sort of exposed to these 3 sectors with a reasonably diversified portfolio, I think you should do pretty well. Yes.
Very interesting. 15 to 25%. Wow. If you get that,
that's
a lot
the
of retirement
opportunity.
plans can come
That's
through
the
on
opportunity.
that.
Yeah.
Okay. Someone who's watching this is kind of just, he's buying everything that you're selling.
Yes.
What's your advice to him if he's never ever done stocks before? Okay. And I'm talking to an equity brokerage. So I'm going to ask you about what's your advice to someone to open a brokerage account? What are the things to look out for when you choose to open a brokerage account?
Okay. So 3 or 4 things. So one, if you're not sort of experienced in this entire sort of sector, the first thing that you need to look at is the lineage of the brokerage house. So which means are you dealing with somebody that has an office near you, has been around for a long time? Meet the relationship managers. Who are the people who are fronting with you? Because you would need that hand-holding, right? It cannot just be purely digital. Second, of course, look at the technology support that he's giving you. So in terms of servicing, Saturday, Sunday, 24/7 kind of thing. Does the app sort of make sense to you? 3, look at the track record. So which means you should be on the web searching for information on incidents in or around the brokerage firm, typically how you're rated, etc. 4 is, I think, before you decide to jump in, you need to spend at least about a week or so ref checking.
Very
Right?
interesting.
Because any national brokerage would tend to have enough relationships with somebody that you know.
Okay.
Once you've done this and once you've qualified the broker, I think the next step would be to enter the markets slowly. So which means, whether it's my report on my top picks, enter through an SIP route, even using stocks.
Stocks, yeah.
So we have set up equity SIPs on our app, on our web, and we constantly encourage our customers to sort of, so get into that SIP mode, start understanding what a contract note means, what a ledger means, so that you become comfortable. And then, of course, sit with the relationship manager or the advisor that you've got, figure out the plan of investing over the next 3 to 5 years so that you can be guided. So I think these are the essential 3 steps that you need to take before you sort of jump in whole hog.
Yeah. Fantastic. So, what would be your advice, now that someone has opened his or her brokerage account, what would be your advice to him or her on wealth creation, especially for, for people who are less than 30 years of age?
Yeah.
You've already given sectors to sectors to invest in. You've also said how to choose a good brokerage. But top-down, overall, long-term view, how do you, I don't know whether you get asked this question in the places that you go to, friends that you meet, parties that you do. Advice on wealth creation to investors under the age of 30.
So 3 things. 1, take a decadal view, which means don't think about next week, don't think about next month. Pick out about 10 or 15 themes that appeal to you. Because of your educational background, because of your family business, you might get interested in certain ideas, you might not be invested in certain ideas, right? So pick out about 10 or 15 stories that you're not likely to touch in your portfolio, irrespective of what happens for the next 10 to 15 years.
Okay.
Engage with the financial advisor. Number 2, it is absolutely essential, especially, when you're around 23, 24, you got that extra pocket money. Don't overspend on things that you don't need. Put up SIPs. Put up weekly SIPs, not monthly SIPs, but weekly SIPs.
Wow, okay.
Right? Let it be a small amount. It is amazing what a weekly SIP can generate over a decade. Right? It's absolutely shocking.
Sure.
Right? Number 2. Number 3, do not go whole hog, do not leverage. So which means I would strongly suggest, unless you have an experience and a certification in derivatives, stay away from derivatives. It's a very, very seductive and attractive thing. Stay away from that. Follow the first 2 principles. I think you're on your way.
Very interesting. Very interesting. All 3 are, it shows that you've handled this question very well, and I don't think these 3 things will change for a while.
They should not. Yeah, these are basic principles. It just needs to be. People think of markets as a gambling machine for overnight profit making, but the real money is made over decades. Right? And for a less than 30-year-old who doesn't need the money overnight, there's no reason for him to speculate.
How do you handle crashes? Right now, I know that someone who came in 2020, and this is the pushback that a lot of people of our generation, like to throw on these people is that you've not seen a crash and all. And I kind of remind them that listen, they came when the market was down 40%. इन्होंने तो crash देखना था देख लिया यार. मतलब और कितना उससे कितना होगा. And उसके ऊपर 5 साल में over the last 5 years, by my count, we were at least 15% plus crashes.
Correct.
SIP money has not moved.
In fact, today, just before I left, I think AMFI released their latest data, 26,500 crores.
There you go. So
it's huge money. I mean, $3 billion a month is huge money.
That's good behavior.
Absolutely.
How do you handle losses is what my question to you is. In this 3-tier or 3-step process of wealth creation, psychologically or just, as a thing for someone who's not used to this.
Yeah.
How do you think losses should be handled on this long path of wealth creation?
So I think when you're set out for equities, if you're aspiring for a 15% kind of a return, the first thing that you need to think through is that you're buying into a story. It's like investing in a child, right? You don't get swayed every quarter by the child's results. Similarly, when you're buying a stock, remember that you're buying into a decadal story. The company is not going to make something happen overnight for you. You've got to believe in the underlying. I mean, defense is such a story, right?
Yeah.
So the first thing that you need to do is understand the long-term theme, why you got interested in that idea. Because the minute you do that and you have a perspective on that and you have strong belief in the underlying story, every time the price crashes, naturally the question you're going to ask is, abhi le lu kya aur? Right? Your mindset changes.
Okay.
So the first thing that younger guys especially can do, because they have exposure to so much social media, right? I mean, coming home, just watch a YouTube video and you'll understand this. So constantly believe in what you're investing in. If you're not going to believe it, if you're going by somebody else's recommendations because for some reason you don't have the time or possibly you've not developed the belief system, then always keep in mind that markets are going to correct by 20%. Always have at least 10% cash in your portfolio.
10%.
When they do, rotate your money. Buy cheaper.
Nice.
But in neither of the two situations should you exit the markets because equities will always only make money in the long term. We are looking at this country as a long-term phenomenon. Prime Minister Modi keeps talking about 2047. All the youngsters should think of at least 2047 as the first destination when they should look at reviewing their equity portfolio.
Fantastic. Okay, Sandip, we are done. We have just 2 standard questions that we ask all our guests who occupy this seat. The first is what we call the career corner. What if at all your company is hiring, what jobs do you have on offer and what are the qualities that you look for in candidates?
No, we are hiring. In fact, while I'm sitting here, we're in the process of hiring 200 relationship managers across the country. 200 is the kind of number we want to be able to hire.
People really need relationship managers.
Correct, absolutely. In terms of the quality, so while so like I said, not only for the investor, financial markets are very complicated. So we need somebody with a passion for financial markets, not a job. It's a passion. Remember that it's the customer's hard-earned money. You should be willing to work on Saturdays and Sundays. Now, the difference between working and actually being passionate is that you pick up the phone with a smile if a customer calls. So 2, we are looking for the positive attitude that goes with this market. And 3, of course, we would need certifications. Obviously.
But that's required by the regulator.
Basic minimum, right? Other than that, we are looking at somebody who's been around for at least 3 to 5 years. From our perspective, because that person would have engaged enough with customers and therefore brings in that skill set. So I think passion, certifications, and the right attitude. Willingness to learn. If you've got the willingness to learn, we'll make you a champion. But the other 3 is something that you need to have inherently.
That's good to hear. I mean, when I at least the relationship managers that I have had in all my financial products, less said the better. I don't know what's been your experience so far.
No, it's a mix. I mean, you're right. It's a mix of... See, with quick growth comes a lot of excesses, right?
Yeah, but at the same time, I very clearly remember the ones that were really, really good.
Yes.
Okay, because those are the guys who really handhold you. I just feel there's a lot of scope and a lot of opportunity for someone who has that passion who sits and invests himself into that. Because helping someone with his finances and being with that person on a journey is something that can,
and multi-decadal. So I'd like to, in fact, Amisha keeps talking about it and I'm sure so we had a recent event at our head office and one of the customers says, Amisha Ben, do you know who I am? And Amisha said, no sir, I don't. And he said, I'm the third generation in my family that's dealing with Prabhudas Leather.
Wow.
My grandfather started with Prabhudas Leather, and today I am there with Prabhudas Leather. And all of this journey started right when PL was found. And for 80 years, that man says, I have loved your organization.
Wow.
Right? So imagine the kind of effort that would have gone in building a multi-decade generational kind of relationship. So any relationship manager should have that view, right?
Yeah.
That it's not just this person and his wife,
Yeah.
it's the children and it's the children's children.
Yeah.
If you sort of believe in building wealth, I think this is the right place. It's a very exciting place to be.
Through markets, going up and through markets
Oh,
going down.
absolutely.
And your customers remember you, your clients, I shouldn't say customers, your
Correct.
clients remember you when the markets are down.
Correct.
Yeah?
Absolutely.
Folks, so if you're looking for a career in relationship management, RM, you know where to go to. And last question, Sandip, any book you're reading or any content recommendation you have for our audience?
Unfortunately, the markets haven't had given me
Give
any
it too
time to
much
read.
time to-
But I'll tell you what, I've sort of kept it there. So
Please.
there's a very nice, but it's nothing to do with finance.
That's okay.
It's
That's
a personal
okay, yeah.
fascination.
Yeah.
So there's an author called Jerzy Kosinski.
Okay.
He wrote something called Being There, which I read about 2 decades ago.
Being there.
Being There.
Okay.
Okay, and it's a very simple story, amazing story, and I can relate it to the finance world or even international personality. So it's about a gardener who has not seen the world.
Wow.
The boss dies, pushed into the limelight, and almost becomes the president of one of the greatest nations on earth. So it's the entire conversation. How the world misinterprets what he wants to say. Very innocent man. Very exciting thing. I remember snippets of it from 20 years ago. The reason I picked it out is because I'm seeing a couple of international things that are happening which reminded me of this book. I'd welcome all of you to read it. It's a very small read. I think you can finish it in 6 or 7 hours
I
max.
tell you, of all the guests who come here, I really like the ones who give me these books that I have not heard of and that are
and there's a
completely
movie as well. I didn't like the movie so much, so I went back to the book.
What book?
Being There stars, I think, Peter Sellers.
Wow. Oh.
So, yeah,
Acha.
so it's a fascinating read. I mean, it's hardly a couple of hours here. There.
Crazy. This is a very interesting recommendation on the book front. On that interesting recommendation and a whole lot of tips on career and building wealth, that is a wrap on this episode of Paisa Vaisa. My guest, Sandip Raichura, CEO, Retail Broking and Distribution and Director, PL, or as I like to call it, Prabhudas Leather. Sandip, really thank you so much for doing
Thank
for
you.
our audience. And
Thank you.
come back, send us your research people, send us the
course.
institutional people, and I would be happy to have them talk about their ideas.
Of course, pleasure. Thank you so much.
Folks, as always, like, share, subscribe this channel, and thank you so much for watching.